Well, it's certainly the tariffs right now, coming off after the Fed just raised rates again, will continue with their policy. The ECB said they're ending QE essentially in September, even though we'll get a taper in the fourth quarter. So I think a combination. I mean, the economy is going to have a good performance in Q2, probably will follow through in Q3. So the market's saying, okay, what can disrupt that? And certainly higher interest rates, tighter monetary policy, and the tariff escalation could.
Is that the right way to look at it? Because the market keeps trading back and forth, thinking, okay, we're going to focus on earnings and the strong economy. Oh, no, wait, we're going to worry about these things that could throw us off. What's the right way?
Right, this is the constant tug of war,
right.
Which the end result is a market that's, a little changed over the last 5 months.
And you would say the thing that rises the most to you would be the economy or the issues about trade?
I remain most worried about how does the economy handle a tightening of monetary policy as we get deeper into it. How's the European bond market going to handle the end of QE? We've already seen, obviously, what happened in Italy, and is that a precursor of more volatility to come there? Those are the things that I'm focused on, again, in the context of a good earnings quarter, which will continue for the next few quarters. But it is that tug of war, and it's a standstill right now.
Hey, Seth, what do you anticipate from the Fed? They have come out and kind of given us their guidelines, but then the economy looks like it's improving at a more rapid pace than they are anticipating. So what happens?
Yeah, so we've been consistently pretty upbeat about the economy. We think the fiscal stimulus is going to do a lot to boost the economy. We think oil production in the U.S. is doing a lot to boost the economy. And so we see the Fed just continuing to raise interest rates 2 more times this year, probably 3 times next year. But what's different, in our view, is for the first time in I don't know how long, maybe a decade, our baseline view for the Fed is up, but we also have meaningful risk on both sides. We can easily imagine the Fed hiking even more than we anticipate if the economy continues.
That would be what I would assume would be the base case scenario, more than they've laid out at this point.
So relative to what they've laid out, I mean, I think this is where Jay Powell has been trying very hard to damp down how closely people follow their dots. He wants to take things one at a time. We think they'll hike 2 more times this year, 3 times next year. But if we keep getting surprised to the upside in terms of the real side of the economy, and we've been pretty optimistic they could do more.
Does that matter, though? I mean, if the economy is stronger, isn't the Fed warranted in raising rates a little faster? Can we handle it?
Absolutely. That's our view. Our view is that the stronger underlying economy is going to be the thing that keeps the Fed hiking.
Except, what about the euro, though?
Right. So the euro, I mean, it matters, but it only matters within context. So the dollar is one of just many aspects that affects the economy.
But if they truly have some issues, and who knows? Look what's happening this week with Merkel. I mean, I don't know, Italy, everything else. And I still think that the Fed is cognizant of where rates are over there and what Draghi's doing, and they're slow walking this.
No,
tightening.
I think they're
so aren't we tethered a little bit? Don't we have to think about? And if we had like 110 on the euro, which would be good for me because I'm going on this week, but that hurts. If we're worried about trade deficits. And
so I think it matters some. But remember, the reason the Fed is hiking is because they want to slow the U.S. economy. The U.S. economy is growing at an unsustainable rate, and if there's a bit of a drag from the external sector, that's part of what they're trying to do.
I don't know if I buy that. What you'd rather have 2% than 3%?
Growth?
Yeah.
So we've got an unemployment rate that's at 3.8% and falling. We've got to get into 3.5%.
But inflation and wage growth doesn't seem out of control.
So inflation, the Fed's just said inflation just hit their target.
Right.
And so if you've got growth that continues to, if you got growth that continues to be above what's long run sustainable, that's not a situation you want to keep for too long.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.